prices will fluctuate. Yes, the underlying price of the stock will fluctuate and the individual option prices will fluctuate. Number two, the only other rule, absolute rule of the option market is that these contracts will expire. Any option contract that you buy on any stock will expire at a certain date in the future. If we were to purchase these May options, the ones that we're looking at right now, expire, and we have the expiration date right here in 24 days. Normally, the options expire on equity and index options the third Friday of each month. That is the last trading day for those options. Purchasing. So, for example, if you thought there was an imminent move in Activision, you could purchase this option for 40 cents today at $27.50, and if the stock did move up beyond the $27.50, you would actually start making money. But what happens if the stock doesn't move? Well, if the stock doesn't move, slowly, day by day, this option that you purchased, if the stock does not move, would slowly erode in value. Why? Well, the reason is that you have the right as a call buyer to purchase the stock at the strike price that you purchased, in this case $27.50, at any time before the third Friday of May. As we get closer to the third Friday of May, the chances of that stock moving up beyond this strike price of $27.50, above the price of $27.50, becomes less and less certain. And because of that, the option has less value to it. If the probabilities are less that the stock will actually move above $27.50, then obviously that the value of holding that position, that contract, becomes decreasingly less expensive. So, I mean, if you take a look at an option like this over time, you know, let's say that the stock doesn't really move. If over time, you know, like a week from now, maybe this option will be selling for 20-cent bid, 35-cent ask. A week after that, it's 15 cents and 20 cents, or 25 cents. The week after that, maybe it's 5 cents and 10 cents. So eventually, the option that you purchased at 40 cents with great hope that the stock was going to move up is now only worth about 10 cents. You've lost 30 cents on the trade. Well, that's exactly what the person who sold it to you is hoping would happen. That in fact, that the stock did not go up in price, that you purchased this option that they know is going to expire and will eventually erode in value over time. And that's how they make their profit. Because they sold it to you at 40 cents, they can buy it back at 10 cents, making a 30-cent profit on that trade. Well, what about the guy who purchased the put option? The option that gives him the right to sell the stock at $27.50, hoping that it would go down so that he could buy it back at $22.50. If he could buy it at $22.50 and sell it at $27.50, he's made a $5 profit. And that's what his hope is. Now, if the stock doesn't do anything at all, the same exact thing is going to happen to his put option. Eventually, over time, because the actual probability that the stock is going to decline in price decreases as these options get closer to expiration, the third Friday in May, for our example here, then eventually this option will be worth less and less each week. Let's say next week at this time, if the stock does not move, then this option will only be worth maybe 45 cents to 65 cents. Another week passes by, and now it's only because the principles will never change. Okay, guys, trade with confidence.